And good morning, April 17th, Thursday. So we've been holding those positions. You can see the NASDAQ continues to move in our favor. We're up 10,000 on that. We held overnight up 11,000. We made a couple new trades, full-size trades. So we can see soybeans, we're down 25,000, but it's like very sideways trend. We just have to adjust to the fact that if this is going to be a sort of a trade into the spring, into July based on, some more fundamental longer term things that we're going to try to hold it, that we're going to get these sort of fluctuations. But, you know, if we're going to, we went through this big liquidation phase and everybody bought all these puts and so on and so forth. So we probably aren't going to be getting some big flush down, um, not anytime soon. But anyways, this longer term chart doesn't look like gold or anything like that, so I wouldn't compare it. But if you compare this liquidation and then this immediately shot out of it and closed higher than where we were, and then we've got this chop like this. So, at first I wouldn't want to touch this because the first day or two, because I'm expecting something lower. But after 3, 4 days of this sort of bouncing around up and down, it sort of gives you, oh, okay, this is not this is not a downtrend. This is as it has been, especially if we look at the weekly. This is a daily chart, but if we look at the weekly, we've had this downtrend, but here we are, coming to spring. I mean, here's April. So we made this bottom well, this is May 19th. We made a bottom last year, and then there's your rally into June, July, and down. So even when we're in a bear market, we'll have these short rallies, and just looking at this and how it just appears this is the spring bottom, and that we can hopefully get a rally here. So that's sort of the concept here. It's one green bar alone. That's 1 week, coming out of a big liquidation. You don't see any of the red bars like we saw in some of the other commodity charts. So this is clearly got a little bit more face on it. Um, So yeah, we're just literally instead of $10.53 a bushel, we're at $10.44 a bushel, but we got 60 contracts, so it's pretty volatile there. The other one was gold. So gold, we took that big $70,000 profit. So I waited for a retracement and bought it, and it went lower than the spot that I bought it. So we're down 24,000 in that. But again, that's something. A couple of these trades now that we're back at business as usual. Going to try and take a little bit bigger positions, let a little bit more volatility come in, knowing that right now in this environment, that's going to be um, a little bit better way to trade. So just to show you the gold chart. Um, so here's the daily chart. Well, here's the weekly chart. So you see it's quite a run. And, especially after this liquidation, you've got to just sort of hang on to it and understand that yes, this looks crazy. It looks scary to be buying up here. But, you know, you've gotta go with that momentum, especially out of this liquidation phase here, and just looking at things. It's just something you learn and experience. You've got these periods where it's making new highs, but it sort of runs out of gas. But you've got periods where it's just very strong, and there's going to be some carry through, and that's sort of where we're in. So we've got to sort of deal with this volatility that we're dealing with right now. And so you can see it's down on the day. And I'll just show you a closer um, bird's eye view here. But you can see in the scheme of things, this is really not that. Turn off these pennant breakouts, but you could see there's this liquidation phase, and this chop down instead of some of the others that look like a falling knife. Again, reiterates is a strong market. So there's your first leg up. There's the new highs it made. There's this retracement. So we bought in here. We rode this up. we sold here in this little first range. It retested here. And then once it came down here, I was buying it when it came back into this range. And then we sort of plopped down here. So that's fine. This is a, you want to always look at the size of these legs up. And as long as this leg up is big enough, even if it were to come all the way down here, which is, a long distance, you're going to retest the high. So we'll be all right here. We just got to hang on to this big position and we'll sit through some of this volatility like we're having today. It's just, I mean, look at this. This was literally like a 12-hour correction here, and we're literally at that point. So, it can go on longer. Since we're further into this rally, the correction may be a little bit longer, but when it breaks up to new highs, we'll expect an even bigger leg up. If you can believe that. We went from 3,000 to 3,300, so 10%. We went up in 1, 2, 3, 4, 5, 6 days. So once this thing starts again, the 6 days, it'll be at more than 10%. Normally, you're looking for a bigger uh, rally on it, like a sort of secondary leg up. This is the first leg up, so we'll have a retracement. So next leg up. So what we're doing that. So the real interesting thing is crude oil. I made a mistake here because it's been the weakest market, and so I'm trying to reshort it with the stock market. And this is, I guess you could say this is a little bit not used to government intervention, but the chart, it looks different, right? So the other charts, like if you look at copper or the stock market, we've got this big 1 day rally that we had. They all share this sort of rally where everyone just short covers everything out of this liquidation phase. Get this correction for it. And then we have this chop, chop, chop higher, and then it starts to roll over. And crude oil is the exact opposite. It's actually gaining. We can see this gaining momentum, and look at this bar today. So we took a pretty sizable loss in at 30,000, and that's just like, oh, duh. There's an artificial buyer in there. That's good buying no matter what. And so if you have a massive wave of liquidation, sure, it's going to swamp that buyer. I'm talking about the U.S. government. But when you have periods of that, once the liquidation phase is over, and you get back to business as usual, there's an artificial non-market motivated buyer in there that is unaffected by, let's say, market conditions, and they're just going to buy it all the way up until it gets up to 70. So, sparring any further liquidation scenarios, which we just had. So, people are sort of prepared for it. They've got their puts. They're ready. Everyone's fearing the next leg down, and so, right now, the worst is out. So it's like we're not doing well. The economy's not doing well, but we're not gonna have if we're not gonna have these liquidation phases, or not at least not for a while. Um, there's no one to stop crude oil from just ticking higher as long as there's a government buyer up there that apparently they're buying it all the way up until 72. Sometimes we've got a $10 run to the upside. That's $10,000. I've got 18 contracts, so that's $180,000. So heck, we should just hold it till we get up $180,000. Um, and just sit on that. I did check out the numbers on how much strategic petroleum reserve we had before the Russia-Ukraine conflict and how much we have now, and how much they're willing to buy to restock the strategic petroleum reserve. And it's a very big number. Like it's a big number. Like it could go on for a long time. So there's no shortage of buying to come. Um, and that's sort of the story on crude oil. So we just flipped the position. We just flipped the position. You can see how the market normally works. It runs out of gas and it falls over. This is like liquidation and liquidation. Uh, you know, you have to correct that. So you correct halfway, and then this is just gaining momentum, not losing. There's no rollover. Or if you compare that to, like, let's say a copper, you know, let's look at copper real quick, just to show you an example, because it's very similar, you know, in terms of, both economically sensitive, both to trade, the stock market, both get liquidated in a potential you know, scenario, bad economy scenario, but you can see it's just a different situation. It's just like there's a big rally day, and then just gets chopping. Yeah, it did make this new high, but it just sort of ran out of gas, and boom, boom. It's just sort of boom. So it's sort of taking higher, but it's sort of run out of gas. Does appear to want to go through here. And I think commodities in general are the buy now. It's like, okay, high inflation, let's rotate into commodities. So you've got copper, it may keep going higher, but it doesn't have that artificial buyer that crude oil does. So it's sort of stalling out here. But staying strong it appears to want to go higher. So that's the idea. I think that's these major global funds. So, the way they think is, okay, there's the stock market, there's the bond market, there's the currency market, and there's the commodities market. And this is sort of how these global macro funds think about it. And so they allocate accordingly. And so, the idea now will be, okay, out of stocks or short stocks, long commodities, long currencies, and short bonds. The short bonds thing is based on high inflation. So, um, one quick chart too on that is interesting. Bonds. I mean, look at this. But this is really when I talk about the monetary markets just more differently than other markets. So if you look at this, very long term chart of the bonds. I mean, look at this going back to 1980. I mean, what a trend! And this is you couldn't really hold this trend through all these fluctuations and all things. But look at this trend line. If you were to draw this bottom trend line, it was never broken. And then going into these financial crises. But what are financial crises? Well, that's what did we start doing? 2009. We're nationalizing the banks. Then with coronavirus, we're printing all this money. We printed 5 times the money supply. So we've got all the financial crises and mismanagement of the financial crises and stealing all the money from the people through inflation and all the money printing. You've got, this is the coronavirus fight, and then that's the end of it. And then look at this. That uptrend line was broken. So all the shenanigans, all the money printing, all the inflation is finally caught up. Now bonds are just not, we're going to be like other countries where the bonds are just, they're going to go back all the way down and trade at, 10%, like all the other um, third world economies, you know. So that's sort of what it looks like. And this is all human intervention. And the markets, I mean, the markets are free markets, but when you have a participant in the market that is like the government or the Federal Reserve that controls the money supply, it's going to influence those things. So, anyways, there is a long-term trend in short bonds, but financial crisis after financial crisis, problem after problem, and bonds will have their day. But it did, I've shown in the other video, they just didn't shoot up with a hill of beans the way the other markets did. I mean, in other financial crises, I mean, pull up a weekly chart here. And let's even do the monthly chart. Let's go back to 2009. You know, and you see out of this situation, this huge 2009. I mean, this at the time, in context was just massive. I mean, of course, we know the bonds continue higher from there, but if you go back to where we've been, and then there's just this huge shot higher, and we won a trade, and then came back to where we were. But it's just ticked higher. So we had the luxury of a environment where we had China and others buying our investments and the economy being good. And then look at this. There's a coronavirus spike. And then the money printing just went bonkers. And of course, I mean, we're still going back to all the Um, well, the money printing and the mortgage investments that all went sour for all the hedge funds that the government is buying up. Anyway, so there's your peak. And now 2024, the whole year of 2024, the market didn't do very well. I mean, the stock market. So you can see it was almost like that year, 2024, was the first year that bonds actually held water. Like they didn't stop going down from that coronavirus peak. They stopped this huge sell-off. So okay, so the stock market's going to do bad. Well, these should have been making new highs or retracing whatever was before that. All they did was just sort of pop up here at the beginning of the year and hold water. So you can see that's all we got. There's coronavirus, and this little liquidation tariff situation, economic. This is all we got was this little tiny little wick. So it just shows you now, okay, that's the state of the situation is that people, these big funds, they're not going to hold bonds in this inflationary environment. So the trade is gold. The trade is gold and other commodities. So we see crude oil picking higher, making new highs literally every moment. I mean, look at this crude oil. I mean, this is a market that, here's a monthly. This is a market that, um, the government's in there buying, so they're artificially supporting prices, which means that producers that take advantage of that, such as in the Middle East and all the oil companies, which are only in favor of the government and their friends, artificially high because there's an artificial buyer. So they're able to sell to the government. It's like welfare for oil companies. So they sell to the government. And let me switch to this weekly. So here's the weekly. And here's this range, 75 to 60 going back the past couple of years. But since, that's some of that was, pre-Ukraine. So prices start going down. So they want to find some excuse to support the market. So they find no reason for the war, and there's no point to that. Our markets are plenty liquid and free, but look at this range. So yeah, just this sideways stuff. So look at this, look at these lows here. So we had a little bit of a liquidation. So they're always buying, but we're still going to have these fun liquidations. But you can see, what is this price? 64, 65, so 64, 65, 64, 65. So this is the support. Look at that. And they ran out of it and they came right back in it and they start chopping higher. So there's artificial burn. And then you have the liquidation of all the money market funds. So technically this should come right back. And, just due to momentum, you know, extra buying, by the time it gets up here, it'll trade above 68. So it'll, get up to here, 70, and maybe even go higher. But eventually it's going to stay here without any crazy economic disturbances. So when I realized, breaking above this, you could see this ledge here. So this is spike and ledge. It's true spike and ledge. And your spike down, your V bottoms, and then building this little ledge here. And this is the pattern the stock market might make, but it's not. And yeah, swap just to now go back and put everything in context and swap this out for this other chart. So yeah, there's this big liquidation. Here's your 64 support, getting up to 70. So there's a liquidation of all the funds that hold crude oil futures. And then here's this sort of resistance area in this shelf build, and today it broke through that. And so I covered and realized, okay, this was a mistake. We've got an official buyer in there, so all else equal, it should trade right back up. So I bought it, and literally, half hour ago, and we look at the positions, and here we are. So crude oil already up in it. So up in that, gonna just continue with the short stock market. It's not cratering down. It's gap lower, trade lower, some follow through. It is down. It's flat right now. S&P 500 is a little bit up, so it's been sort of fluctuating. So it's not running right back up to the highs, is the point. So we're just gonna try and be patient with that one. But the stocks are actually, everything should go up in an inflationary environment. It's just that the growth will be poor because people's buying power is down, stuff like that. So it's just like it's the weaker of the markets, but ultimately, depending on how much money you're going to print, everything is going to go up ultimately. So that's literally what we see playing out. You know, commodities and currency shooting up, and stock market. Well, we had this crash, but we'll see. Is it going to continue down or not? I don't know. I don't know. But I think there's a rotation of the stocks and into commodities right now on a major scale. Mhm. You can see that in gold, that's for sure. It's a major beneficiary. You can see the currencies are moving quite a bit slower. Drip, 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 drip. They're of course inflating other currencies too, but the U.S. dollar is doing the worst. It's really just a comparison trade. They're all inflating. So, anyways, all right, that's what's going on right now. Took a $30,000 hit in that crude oil, but everything else, we're going to try and sit with it for as long as we can, because this appears to be what the rotation is right now. So coming out of the liquidation phase on the volatility in the intraday trades, and I expect that, you know, knowing a trading environment and the types of trades you should be making in each environment are the most important thing. So we're going to try and switch to just some drip, 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 hold daily fluctuations, and we should get some daily trends out of that, coming out of that situation, that go a little bit longer until then we'll get to the point where those things aren't happening, and then we'll rotate back into the different type of environment. So just trying to adjust and as we go.